And I just want to introduce Peggy VENA, our moderator. She'll take us through the panel. Thanks.
Hi, my name is Peggy VENA. I'm the Global Head of ETF Services for Citi Security Services business. Today we're going to be talking about insurance companies and the next wave of ETF growth. To start, I was just going to ask, starting with Will, and to go down the panel for each of our panelists to just give their name and a little bit intro about yourself.
Sure. Will Creedon from John Hancock Investment Management. As part of this panel, make it clear that we are the investment management arm of John Hancock. We do have a large U.S. insurer, primarily life and health, and we are owned by Manulife Insurance, which is the largest Canadian insurance company. But my focus specifically at John Hancock is, again, the ETF capital markets desk. I run a team there, and we're currently in market with equity and fixed income ETFs. About $7 billion under management in U.S. ETFs, divided between fixed income and equity, and hopefully growing that in the years to come, both in the intermediary and insurance channels.
Hi, I'm Chris CARR. I'm at JP Morgan Asset Management on our ETF team, heading up our insurance efforts. Similar to what Will was mentioning, we are obviously separate and distinct from some of the other parts of the bank as an asset manager. To date, we have about 42 ETFs in the market, around $80 billion of assets under management. That's kind of spread across active, passive, and strategic beta. Happy to be here.
Phil CICHLAR from Jane Street. We're one of the lead market-making firms that was mentioned earlier. I work in our institutional services platform. I have a fixed income background, but cover all sorts of insurance accounts, pension plans. But we're here. We're partners with all the firms that are up here, as well as others that are in the audience. So thank you for today's attendance.
Ben Wallishin. I'm with State Street Global Asset Management Spider business. We're, as of the end last reporting period anyway, around $1 trillion under management. I specifically work with U.S. insurance companies around the United States and their general accounts, helping to deliver ETF solutions to their balance sheets. And also glad to be here.
Okay, thank you. And just to help us tailor the conversation a little bit, we're going to ask for the folks in the room, who here, just by show of hands, do we have managing insurance accounts? And do we have folks managing third-party insurance assets in the room? Okay. So I'm going to start with Ben, and we're going to go with a question for you. So the New York State Department of Finance passed regulation allowing for fixed income ETFs to be treated as bonds, which opened opportunities. How has this opened opportunities for fixed income ETFs?
Okay, thanks for that. And per Peggy's question, and also the title of the presentation, Insurance Companies Areas for Growth, a lot of people don't associate the insurance industry as a growth industry, but as it relates to ETFs, as you're going to hear from this panel, there's a lot of opportunities, not least of which because there's a lot of assets at insurance companies. In our universe, we cover roughly 3,000 companies around the country. There's roughly, call it somewhere around 10 trillion in assets, and most of which are in fixed income. So fixed income's a big focus for us. Historically, the insurance companies have bought individual securities, individual bonds from your traditional broker-dealers. Around 2000, there's an organization called the National Association of Insurance Commissioners, or the NAIC for short, and they started issuing what we call designations, not ratings, designations, allowing for insurance companies to hold fixed income ETFs on their balance sheet and to be treated much the same way a fixed income, or exactly the same way a equivalent fixed income security would be treated. The catch, however, is that in the insurance business, each company is regulated by the state where they're domiciled. So if you have a New York domiciled company, they're regulated by New York. If you have an Iowa company, they're regulated by Iowa, et cetera. However, another interesting twist or idiosyncrasy is that a lot of companies have to have New York operating companies. So the universe in New York is quite large. It's actually about 25% of the fixed income market. And up until about December, mid-December of this year, they did not allow insurance companies to hold fixed income ETFs on their balance sheet consistent with what the NAIC had provided since the early 2000s. So through a lot of effort across the industry, but really all the credit to the state of New York, they took the decision to allow appropriate or favorable capital treatment for fixed income ETFs to New York domiciled companies as long as they fit a few different criteria. And very quickly, they are as follows. One, I just mentioned, it must have an NAIC designation. And two, the ETF has to be over $1 billion. It has to follow a passive index. So it cannot be an active fixed income fund. It has to be regulated by the 40 Act. It has to allow for in-kind redemptions. And then it can only consist of fixed income cash and cash equivalents. So a cap on derivatives, et cetera. And then the big thing is that in addition to the others, which sound onerous, but they're doable mostly, is that it must have a rating from a nationally recognized statistical rating organization. I live in an acronym world, or NRSRO. And so within, and I forgot to mention, there's about 200 ETFs that have NAIC designations. Not all of them qualify for New York, just to be clear. We have roughly 27, soon to be 28, that have NAIC designations, and about 20 of them qualify. So it's very exciting for our industry because New York's a big opportunity. And as the rest of the country takes a look at what their regulations look like, some of them are adopting some of what New York has done, not all, because it takes a lot of monitoring to regulate that. But we're starting to see a lot of movement in other very large states of domicile, such as Massachusetts, Iowa, and some others. So as an industry, we're pretty excited about it, and will only enhance the growth of this space.
So I'm going to look at Chris for this next one, and maybe the tail end a little bit from Phil. But what is the current AUM invested by insurance companies, and what are the asset classes that insurance are using? And the piece I'm saying maybe for Phil is just to talk a little bit after that about some of their trading activity.
Yeah, sure. So kind of piggybacking off of what Ben mentioned earlier, ETFs have been being used for, numerous amounts of years, and we've consistently seen just general growth in around the 15% range on a compounded annualized growth rate. So today we're right at around 46 billion of assets under management in terms of ETF use amongst insurance companies. And as what Ben was mentioning earlier, what we're also seeing is that as these regulations come on board, and as the state regulators as well as the NAIC kind of align themselves, we can only foresee kind of increased adoption of ETF use amongst insurance general accounts. More interestingly, when you look at the historical data, ETFs, call it 5-6 years ago, most of the asset classes being used by insurance companies were actually equities, and that was primarily driven by property casualty insurers and health insurers, which is really interesting to see. But where we're starting to see the biggest amounts of growth regarding insurance use of ETFs is in fixed income. So the split between two is roughly 50-50 in terms of assets in equity ETFs and assets in fixed income ETFs. When you peel back the onion a little bit more, what's really interesting to see is how each discipline between life, property casualty, and health are allocating towards ETFs, right? So if you think of a large life insurer, right, they have long extended liabilities because they're managing life insurance policies. They're all heavily fixed income, but in particular with life insurance companies, what you're seeing is a lot of assets being allocated towards longer term or intermediate term corporate bond ETFs, right? If you flip the script and maybe go to the other side of that spectrum to health insurance companies, their liabilities are a lot shorter. The frequency of cash flow payments that have to go out to pay claims, health insurance claims, is much higher, so that velocity of the claim payment is much higher. Therefore, their assets, from an ETF perspective at least, and you could kind of think of it from an overall portfolio perspective, is a little bit shorter in duration, right? So they're leveraging shorter, ultra short duration fixed income ETFs, maybe a little bit of ag bond ETFs. And then when you think of P&C, they're more total return oriented. So there's kind of a bigger blend between equity and fixed income, and you could argue too into the extended sectors. So think of high yield, emerging market debt, things of that nature. So it is really interesting to see how insurers are tailoring their own investment portfolios from an ETF perspective towards what they're generally doing from an insurance business perspective and what is required of them to meet those liabilities. So, as I mentioned earlier, we're seeing 15% CAGRs year over year, and it's just one of the things that is reassuring to us is that if we're continuing to see these growth rates continue, and we're continuing to see regulations kind of come online that allow for more flexible use from insurers for ETFs, right? That's just a tailwind for us. And lastly, maybe transitioning over to Phil, what's really interesting to see is the trading mechanisms underneath it, or the trading dynamics, I should say. So in theory, you would figure kind of intuitively, equities are going to be traded more. But what we've actually found out, and kind of speaking to what Ben was mentioning earlier, given the fixed income focus of insurance general accounts and given the broader adoption of ETFs, fixed income ETFs are actually accounting for a decent amount more of the trading activity when you look at the underlying. So maybe I'll turn it over to Phil, maybe he can speak to that, but it is interesting to see that trading activity overall from ETFs, from insurance companies within ETFs in 2020, right, so a really volatile year, was around 65 billion. We saw about the same amount of trading activity overall volume-wise in 2021. And while that has somewhat flatlined, I would argue that that's encouraging from a trading perspective, considering 2020 was one of the more volatile years that we've seen in markets. 2021 has kind of leveled off. So to see kind of in a more normal environment trading activity that reaches the level of a volatile year is just encouraging.
And just to give a data point on your timeline there, when I joined John Hancock on the investment management side, our general accounts did not own ETFs in any way, shape, or form. As the regulation, as the capital treatment has improved year over year, we're one of these growth stories, right? Our general accounts now own both equity and to a much greater extent fixed income ETFs. But that's really only happened for us just prior to the pandemic, and the pandemic has actually accelerated it, primarily because of some of these trading dynamics that Phil will go into. But in terms of where we are on this growth trajectory, I think very, very early, right? First inning, second inning type thing.
And for Phil, I think the question we want to hear about is what you're doing as far as helping to provide liquidity and what strategies you're employing to help provide that liquidity in these products.
Yeah, so a lot of what's happening, what everybody's mentioned up here, the insurance community had been handcuffed from a regulatory perspective because of RBC charges at the end of every quarter for having to hold these positions. But what's happened in the market, right, since the financial crisis, we've seen a huge growth in corporate debt, right, which has coincided with the index business growing substantially over time. So there's a lot of these index vehicles that are out there that their inherent liquidity profile is greater than the underlying securities on an individual basis. So we actually just put out a piece this morning, and I don't know the stats. I have two colleagues here from Jane Street. Corporate bonds trace volumes in investment grade and high yield are down this year. It's something like down 3 to 5 or 7% on the secondaries. Investment grade and high yield secondary volumes, that's where accounts are coming in to trade on exchange or OTC, are up 30 to 35%. So people are able to access opportunities in the market by trading ETFs where the cash bond market has sort of frozen, or price transparency is not as apparent and it's not as transferable. And in the ETF market, you're able to do that. So 2020, as much as it was a pain point, particularly in the first quarter and the beginning of the second quarter, a lot of insurance accounts, Wills and others, stepped in to opportunistically buy credit through ETFs. They couldn't do it through individual bonds. So they were buying it through ETFs or other derivative type products. So the regulation is opening this up. And what this allows is for more folks to participate in the risk resocialization process. So an ETF for an insurance account or any other institutional player gets transacted in much the same way that a bond does. You could do it through a request for quote protocol. You could trade it on exchange. And I think part of my question that I asked to the panel earlier is, understanding kind of the liquidity paradigms for those ETFs, why New York went with an in-kind redemption process was to ensure that the investors in the fund were being protected on the way out. Now, there's lots of really liquid and unique products. JP Morgan has a bunch, John Hancock has a bunch that don't necessarily have that specific designation, but that doesn't mean that they're not acceptable to use in various cases. So we'll see insurance accounts come in and think about liquidity sleeves. They're thinking about tactical trades. They want beta exposure, which has kind of been the main type of risk expression over many years, or even just cash management. So there's been lots of insurance accounts. There's a portfolio manager who's also wearing an analyst hat, who's also wearing a trader's hat. And it's very difficult for them to know how to trade credit, know how to trade mortgages, know how to trade government bonds, and have the right access into the market because they're not trading every day. So the ETF allows them to use these different products to put risk on and take risk off in a way that's not, essentially destructive to their portfolio. So we've really seen a lot of institutional investors, particularly insurance accounts, think about using electronic trading protocols to access the market and ensuring they're getting best decks. They go out to 3 or 4 counterparties. And in the ETF market, it's not one of those spaces where your broker is going to be very upset that they got put in comp to trade a product, right? You're able to interact with a lot of different folks in the room to get best decks and to get a better understanding of how these products operate. So we've really seen this. I remember in 2018, or heading into 2018, we didn't really have a lot of insurance accounts at Jane Street. And we said, we need to go find a couple of these. And fast forward to 2022, and our insurance base is more than doubled, and the activity that we see coming through is really unique. So something like munis, right? We're in the worst muni performance since 1980. I think munis are down 10% year to date. There's been net inflows into muni ETFs from institutional investors this year, including insurance accounts, while there's net muni mutual fund outflows. So that's right there talking about a liquidity paradigm shift that's taking place that new participants are coming in and getting to take advantage of.
And for Will, seeing more institutional use case now for fixed income ETFs, how is this affecting your product development as far as aligning for retail versus institutional use case?
Sure. Yeah, Phil uses a great term there, paradigm shift, right? With more of the institutional community driven by insurance company general accounts turning to the ETF vehicle, issuers like ourselves, I think, have much wider opportunities for product development and product distribution, but that also comes with some product development challenges because, as some of the previous panelists talked about, there's a fairly well-defined playbook when it comes to ETF product development into the intermediary advisor or retail world, right? It's you find an asset bucket, you find an asset allocation scheme, you kind of work that playbook. But in the institutional world, the use case is somewhat different, right? You're not necessarily trying to solve an intermediary or retail asset allocation equation. You're trying to solve for an institutional challenge, some of the things that Phil just talked about, liquidity needs, transition management, tactical alpha, tactical beta, or strategic beta, all quite institutional concepts that certainly the retail and intermediary market, I think, are gravitating towards. The more sophisticated RIAs, the home office, broker-dealer community is certainly gravitating towards that. But when we think about ETF product development, it's making sure that we're appreciating that institutional playbook and how are we trying to meet those needs of not only our core client, which is intermediary, advisor-based, retail-based, but also this burgeoning opportunity of institutional and certainly insurance client, which we'll call our home team to some degree, and their needs. And that can be a blessing and a curse because some of us, we are focused on active management, right? John Hancock, Manulife, our franchise in investment management is active management. Whether that be factor-based, pure alpha, idiosyncratic risk, whatever those things, we don't believe we can necessarily compete in the beta world that Ben's firm or other firms that I'll call the evil empire. But no, we're partners with BlackRock in many senses. But those are two different roadmaps, right? It's I'm trying to provide unique, idiosyncratic, active management to the institutional world, and how am I thinking about that with products that can potentially meet a true institutional use case as well as that dual mandate of the use case of an intermediary or retail-based advisor.
Yeah, and I think to piggyback off of that, obviously JP Morgan Asset Management, kind of our North Star has always been active management. That's not to say that we don't have passive vehicles or passive strategies and smart beta strategies. But really, to piggyback off of what you said on, the importance of the intermediary community, or the quote unquote retail community, is that to gain institutional viability, you need scale, which is AUM and liquidity. And generally speaking, unless you have an institution on the hook to seed and to essentially seed an ETF, you have to build that up through the intermediary space. So when thinking through product development, you have to consider those factors, because until you get to scale, it's very tough for an institution, whether it's an insurance company or other asset owners like pensions, endowments, foundations, to feel comfortable getting into a product that doesn't have necessarily the liquidity or the AUM profile. For us, it's mostly come from the AUM perspective, because we have great partners like Phil and others to kind of educate on, just because it's not necessarily trading a ton of shares on exchange secondary, you can still access underlying liquidity. But it is one of those due diligence things, because the investors that I speak with on a daily basis, it's not just them from an investment capability. They have to also sell that idea to their board and to their broader investment committee, who might not be as well versed in some of the mechanics around ETFs.
Yeah, and just to add on to that, it's no accident that New York State set $1 billion as a hurdle for that exact reason. For an insurance company or any institution to do diligence on an ETF and really only be able to take a small position because they reach concentration limits, it's just not worth their time. And so on the product development side as well, it's a little corporate buzzwordy, but we call it client-driven innovation. We learn things from our clients every day. And so, in the bond market, for example, you have insurance companies that have bigger bond departments than JP Morgan or State Street, or even Hancock, probably, had through the Manulife is bigger than a lot of asset managers managing fixed income. So we learn a lot from them. And then from time to time, we'll launch products based off that. So we just recently launched a liquid, it's called LQIG, which is Market Access is the index provider. It just came out a week, about a week ago on the 12th. And a lot of that was really driven from feedback we were getting from clients. And so we'll see it all the time. I mean, equity, when you look at factor-based products and other products like that, that was client demand. That wasn't a bunch of people sitting in a lab at ETF Issuers saying, wow, that would be cool. A lot of people are going to buy it. That's sort of a recipe to not raise a lot of money. So unless the clients, whether it's sophisticated RIAs, direct retail, probably less so, but institutions for sure, unless we see some sort of demand pull or something that someone has indicated, or as we were talking about before, the beauty about insurance is it's completely transparent. We know what our clients are holding all the time, and we can kind of base product development off that.
You guys have a lab you do product development? At an insurance mutual fund company, they stuck us in a closet, and we just have to use crayons and pencils.
It's lab. Yeah, in quotes.
And I apologize for not saying this up front, but if anybody does have a question for the panel, please put your hand up at any time, and we'll get a microphone over you to ask your question. Continuing down this path, Will, how are ETFs being used as a hedge in the variable annuity space?
Yeah, I think as these use cases develop, both from the general account side, but also on kind of our annuity base, whether that be variable or fixed side, you have much more use cases for not only beta vehicles that can certainly act as risk exposures or viable hedges, but you also have these concepts of portfolio managers of variable annuities, VITs and what have you, that are looking for traditional active risk exposures, right? They're trying to place a bet to produce alpha, to manage a hedge, and they've found in the past several years that the ETF vehicle is extremely efficient to enter into and exit out of what is, I wouldn't necessarily call it a tactical hedge or a tactical bet, but it might not be the 30-year duration holding that you're talking about with a general account. And they've found it extremely efficient to say, hey, I can just go buy this transparent, liquid, efficient vehicle. I don't necessarily need to engage this portfolio manager and launch a variable insurance trust around it, wrap it, regulate it for something that I might only hold for 2 or 3 years. So there's this efficiency when it comes to ETF usage within traditional variable annuity products that I think will be another growth avenue, primarily right now on the equity side, but I think as you see more fixed income product, more active fixed income product as well, I think that use case and that growth opportunity should continue to grow.
Yeah, and if I may, in the traditional variable annuity space, the products that underpinned the annuities, which mostly had guarantees associated with them, were basically 40 Act type mutual funds, and it's very difficult to get an understanding on a daily basis, a transparent basis, of what's underneath the product. It's usually a quarter in arrears, and so by then, pricing's stale. You don't really know what's inside of it. The beauty of ETFs is you know on a minutely basis what's going on in there. So you'll see a lot of variable annuities, not just from a hedging perspective, but they'll construct their portfolios using ETFs as well. And so that's become a very big trend line in the annuity space. And at the same time, there's, and this gets into insurance, sort of probably too deep of a dive, but there's fixed indexed annuities, which basically track indices, whether it's S&P 500, et cetera, but there's been multi-asset indexes or indices being built using ETFs. And so they're basically like structured notes, so they'll have a cap and a floor. And what better way to hedge those than have an ETF-based index with highly liquid ETFs that are easy to hedge?
And is there a use case for more ETFs in the variable and fixed annuity space?
Yeah, in my view, absolutely. And not just because I work for an ETF issuer. I've worked in the insurance industry as well. And again, as I mentioned before, when you see market volatility like we're seeing today, especially on the downside, and there's guarantees associated with these products, I wouldn't guarantee it, but I can bet there's a lot of conversations being held at places like Hancock about how they're hedging, what they need to do. Do they tell their sales force to stop selling certain types of guarantees, et cetera?
Absolutely, and even on the underlying portfolio level of the variable insurance PM that's trying to manage those risks on a daily basis to more liability-driven investing, I think the growth trajectory of the use case is that there's more and more ETFs that serve more and more end risk exposures or hedge exposures that they're trying to get at, right? 10 years ago, it was a handful of them that served very large beta expressions, right? It was corporate credit, or it was short duration, or it was, what have you, beta exposure. But in this rate environment with, so much uncertainty in the rate environment and so much I guess, lower correlation between duration vehicles, you have these opportunities, I think, for product development where they're trying to express more unique or narrower portions of the fixed income market generally, whether that be a rate or a credit expression. So from our perspective, we worked very closely with our variable insurance team to develop a fairly unique mortgage product, right? Most of the mortgage products out there in the market were passive and have turned into agency-only mortgage products. But they wanted something with a little bit more credit risk that wasn't necessarily pure agency. So that was one of those kind of product development exercises where you bring something unique to that institutional use case, that institutional need, that we think in the future, certainly in this rate environment, is going to serve an intermediary and a retail purpose as well, because that community has to get much more creative with their fixed income allocations, right? It's not a 60-40, I'm buying the ag solution anymore. It's now I have to break the ag apart. I need so many more avenues of risk management, avenues of yield generation, so many more tools in my toolkit to manage my fixed income allocation that I think the ETF vehicle in general is going to be a great solution to that conundrum that the advisor community is facing, because we're providing more idiosyncratic building blocks. Now again, the great debate will be, well, how far can you slice it without over-slicing it or over-diversifying? But that's, I think, the debate that's just beginning now and will rage on for years to come.
I'm going to change gears a little bit and talking to Phil, being the sole market maker out here on the panel. How can ETFs in the create-redeem process be used by these managers to help manage their inventory?
Yeah, that's a great question because I think there's a lot of discussion around that. So as a market maker, we're creating and redeeming shares of ETFs versus the underlyings all day long, and we work closely with the different issuers. So for us to be able to provide the best experience possible, it's important for us to carry inventory, right? So you look over at an insurance account, and they're going to carry a lot of bonds. Now, it's something like 70% of the corporate bond market only has a one-sided quote. And not every bond trades, right? Bonds go to bond heaven, or you want to call it something else. But pension and insurance accounts don't really recycle their bonds that they're getting on new issue allocations. So we've seen, and there's been, State Street was definitely involved in some of this narrative, as well as a couple other issuers where, it was called a zipper trade, or you guys called it something else, right? I forget. So issuers were taking their portfolios and insurance accounts were going to issuers and saying, hey, I got this basket. This basket looks like your ETF, or we know all of these bonds are in your ETF because that's the index that we track. And they were asking to do a creation, right? So I'll give you my bonds and I'll get back the ETF shares, and it's done at NAV. Relative to where the marketing service for that product is. Now, the problem with that is it's very difficult unless you're delivering a full pro rata slice of the ETF to receive back those shares. So insurance accounts were trying to do this, but getting stuck on like a 40% hit rate for investment grade or a 20% hit rate for high yield. So what we've actually seen is insurance accounts start to do what's called a bond portfolio trade. And it's where everybody's talking about being a new rage. It's about 5% of the actual secondary trading activity going through the corporate bond market. But portfolio trades have been around in credit for a long time, particularly around CDOs and CLOs. So we've seen insurance accounts look to do a portfolio trade versus an ETF for a completion, right? So if they go to State Street with $100 million of 5 to 10 year credit, which would go into this ETF called SPIB, State Street might turn around and go, hey, we could give you 40 million of that. And the insurance account's really not very happy, right? They just showed their hands, and they're only getting back a 40% fill rate. So what we've been able to do is help clients get 100% allocation into the ETF. And there's some basis, right? There's some price risk there. But we've seen insurers who don't know where these bonds should be trading, there's a lower liquidity profile, move out of inventory in the underlyings and move into the ETF. And that kind of parlays into another thing that we're going to talk about at some point, where different ETFs have different opportunities in the financing world, right, through sec lending. There's ETFs that are trading extremely rich, and you can take your position and generate a significant amount of additional returns in your portfolio because the float in those ETFs is low, even though they might be trading a lot on exchange. And that kind of gets buried into this whole create-redeem process, where if an ETF is trading, at creation bounds or redemptions bounds, there's actual flows that go in. But if an ETF is trading at a price point where it's very difficult to source those underlying securities, you're going to see buy interest come into the ETF, but the underlyings are kind of lagging from a price performance perspective. So there's a lot of really unique things going on within the insurance manager umbrella, and it's usually a bandwidth issue for them to take advantage of it. So I would definitely recommend folks to talk to the different issuers whose products that you're looking at to think about, are those opportunities available? There are even instances where you own the ETF and you can redeem the ETF, it came up on an earlier panel, and take delivery of the bonds. So could you get an optimized basket for what you want? Possibly. But you can definitely take a full pro rata slice of the securities that are in that ETF. So if you want 2,000 securities, you got them. If you want 100, it might be a little bit more work, but those are discussions that can definitely happen.
Absolutely, and we're an example of that. Coming out of the 2020 pandemic, some of the first interactions that we on the investment management ETF desk had with our insurance companies were discussing dynamics like that, right? Zipper trades, we'll call them. But the reality is they can look at it in the reverse as well. To Phil's last point of coming out of the pandemic with spreads blowing out, they just wanted more credit risk because they thought it went too far too fast. So they bought an ETF in a transitionary fashion, right? I'm going to take beta exposure on that risk exposure, right? I'm going to buy corporate credit. I'm going to buy SPIB, SPIG. And 6 months later, 9 months later, whatever the tenor of their investment, they can turn around and say, okay, State Street, I want to, or in working with Jane Street, I'm going to redeem this ETF, but instead of taking all 2,000 of these credits that are in the ETF, I'm going to work with Jane and State Street and only take 50 of them or 100 of them. I'll take slugs of cash, and with that slugs of cash, our insurance company would do much more esoteric things, right? They'd buy privates and all kinds of things, but they would use the liquidity efficiency of the ETF create redeem in really a unique and new way, right? Like, sure, it's been happening for a few years, but I think more and more insurance companies and institutional investors, it doesn't have to be an insurance company, will utilize that liquidity dynamic to help manage their fixed income allocations much more tactically, if you will.
Yeah, and I think going through from a regulatory standpoint, especially on the life insurance side, there are diversification limits that they have to uphold. So to perform some of these trades of I'm holding a corporate bond ETF and I can take in those bonds, that'll help them increase their issuer account that's into their portfolio, which will then help them from a regulatory standpoint, from a risk capital perspective too. So like everyone was saying here, I think as insurance companies think through the flexibility and the versatility of the ETF wrapper, there's just more and more use cases that come up on a monthly and a daily basis.
And those regulatory oversights can be dicey. I should have called Ben when we launched that mortgage fund, because I wish I knew some of those NAIC rules 2 years ago rather than 2 months ago. Yeah.
I'm going to take a question for a minute. I see Mr. Hempstead over there with a question.
Thanks. I'm just going to touch back a little bit. Something Phil said. I have a question related to the NAIC requirements, for fixed income ETFs. You're up there talking about the massive efficiency and use cases for institutions and insurance companies with these fixed income products. But you also said earlier that there's a $1 billion hurdle, to get that approval, which for me, again, my background, it's like, why $1 billion? Who made that number? It's a finger in the air, and it's a frustrating benchmark. I mean, is there any chance, because it really limits the ability of an investment manager at an insurance company to choose perhaps the most optimal product in the market because it doesn't have $1 billion, even though functionally it could do just as much as one of the ones that's already NAIC approved. So is there any hope in educating these commissions to lower those hurdles and, give the institutions a better menu to choose from?
I'll let Ben answer, but Chris, would you be able to fund lobbying efforts of the ETF asset management?
Of course.
I was going to say, Phil and I just flipped a coin and I lost, so I get to answer it. Yeah, I mean, I think, and Phil alluded to this earlier, is just because the ETF might not have the $1 billion in it doesn't prohibit the insurance company from buying it. In fact, there's data that shows that New York insurers were buying fixed income ETFs prior to mid-December of last year as interim beta placeholders. So if it's an exposure that the insurance company has efficacy for their portfolio, they can buy it, take a capital charge if it makes sense for them. They can buy it and not hold it through reporting periods if it makes sense for them, et cetera. I would also say that, as I mentioned at the outset, we have several funds that don't meet the $1 billion hurdle. So I understand that. And I think, if I were to put myself in their place, which I probably shouldn't, they wanted to draw the line somewhere. And it's generally accepted that $1 billion is a hurdle for an institutional investor. So, as I said, we have 27 funds with NAIC designations, and 20 of them qualify for it. So, it's a very large slice of the market, but it's not the only market in the United States as well. So, whether or not they change that, the regulation just came out in mid-December. It's supposed to sunset in 5 years. We're hopeful that it doesn't go away, that it just gets renewed. And I think as the regulators see positive trading experience, more and more insurance companies holding ETFs on their balance sheets, more use cases. After all, the regulator is there to make sure as best as possible that the insurance company remains solvent. So they need to see some experience. Maybe in time things will change, but I think for now this is where we're at. Would we like it lower? In some cases, maybe, but it doesn't preclude the insurance company from expressing a view in an asset that they want to express a view in.
Yeah, hemp, just to kind of tack on to everything that was said, it's not going to stop somebody from trading it. It's going to stop them from holding it over quarter end, right? So tactical usage of active ETFs that may not fit that designation, we kind of expect that to happen, right? There's going to be opportunities where Chris's product, JPST, looks too darn cheap for where it's at for somebody that's an insurance account not to take advantage of that. Now, they're probably going to get out of it before quarter end, or they could sit on it and then it gets treated like equity against their books. So to Ben's point, you got to kind of draw the line in the sand somewhere. The regulators have to get comfortable. New York State, as much as there's a lot of big players, there's been a lot of folks trading ETFs that don't necessarily even fit that size, that probably weren't part of the lobbyingist efforts that went through on this. But like everything else, you got to start somewhere and then figure out where it goes.
Yeah, and these, as we all mentioned, I mean, these insurance general accounts, and they also have surplus, which allows them to invest in all kinds of interesting things. So sometimes you'll see insurance companies express investment views in the surplus accounts off the asset and liability management track. So there's all kinds of opportunities. I mean, if there's issuers in the room who are looking at the space, et cetera, one set of regulations shouldn't preclude conversations from happening. I mean, from my perspective, the more ETF people in the space, the better. So, we encourage that. And I'd also say on the last question around trading and in-kind, our collective relationship with the dealer and market-making community is very important. We deal with some very, very sophisticated people who've never traded ETFs before. So they love the story, but it could fall apart as soon as they try and make a trade. So this ecosystem up here, as it relates to our space, and I think institutional in general, because it's on a growth trajectory, it's not, it's certainly not reached scale yet, is so important.
Yeah, it's all part of a journey, right, Chris? I mean, 5, 7, 10 years ago, the same thing was happening in the retail intermediary world, even with passive ETFs, right? It was, it's got to trade X amount, it needs X amount of AUM. I think a number like that in the insurance space, I think just shows how early it is in the game there, right? Like, I agree, 1 billion, somewhat of an arbitrary number, but to start somewhere and then start the educational process, right? We've all been educating investors for many years on the beauty and the efficiency of the ETF structure. Insurance is just another place we have to chop the wood for years to come.
We're looking at just a few more minutes left, so if there are any other questions, I would encourage folks to please put your hand up now, and we have one over there in the back.
Thanks. My previous life, I was in insurance portfolio management. I'm like the crypto guy, but here I go. In terms of downgrades, I would anticipate like this current period or next year, I'd like to see some like credit defaults. And how do you, again, one of my issues that I dealt with was downgrades in terms of, you said it was $1 billion and also passive management. Let's say you had a downgrade, right, from just, first of all, I like to know how these, like, how are they rated? You said that, I think 27 of them are rated in the NAIC. And then what happens because of the passive management? What happens when they downgrade? How do you guys replace them? Do you replace them? Obviously, that would be a more active management role. But what happens? And does the ETF downgrade as well? I mean, just an overall question.
Yeah, I mean, just from an NAIC perspective, they renew the designation every year, and and there's gradations within each number class, and so it's very possible, and it happens all the time. Usually, it doesn't go from an NAIC 1 to an NAIC 2, but you might see some differential within the band, like NAIC 1A might go from NAIC 1A to 1C or something like that. And so they're always examining it. As I mentioned, in New York anyway, you have to have NRSRO rating, and we're rated by S&P Global Ratings, and we send them files, and the NAIC, same thing. They're available every day for them to look at various holdings, and it's entirely possible that ratings may change. To the other part, I defer to you, either one of you guys.
Yeah, and I think the process is fairly formulaic, right? We have 6 rated ETFs on our platform, and it really is just kind of sending them over to the NAIC or to the NRSOs to just kind of do that. I think the point you bring up, though, around degradation of credit throughout the ETF, specifically in fixed income, at least one of the things that gets us excited at JP Morgan is that having an active manager kind of select the credits is something that kind of aligns with what some of these internally managed, especially internally managed insurance companies are doing. As Ben was mentioning earlier, they're overseeing some bond portfolios that are bigger than some asset manager bond portfolios. So they truly believe, obviously, in actively managed security selection. And I think from what we have from a fixed income perspective, whether it's a JPST like Phil mentioned earlier for cash management purposes, or whether it's high yield or emerging market debt and some of those less efficient asset classes, I think that's where you're going to start to see more active management kind of come in. And for us, similar to what Ben was saying earlier, right, the ratings is at the portfolio level too, right? So JPST is an investment grade ultra short product. It's an NAIC 1 versus, let's say, JPHY or high yield ETF, that's an NAIC 4. Again, so it all kind of comes at the portfolio level as well, as opposed to kind of the single issues.
And our funds being 40 Act funds, we're conscious of those regulatory thresholds and guidelines in product development, right? We're not going to have the opportunity as a 40 Act to go over certain exposures of fallen angels or less than investment grade or what have you. So hopefully there's a coming at that from both angles of the equation, so to speak.
Right, so the NAIC process is like independent and annual, right? Whereas the ETF is going to be tracking an index, so if you're thinking you're going to have IG bonds getting downgraded to high yield, that's going to get reconstituted at the end of a month when there's a rebalance for that, right? So you could potentially have some noise at some point, but I can't imagine that State Street, JP, iShares is going to have an investment grade ETF holding 40% high yield, going up for an NAIC review and getting the same #1 rating. Like that process just wouldn't even happen, right? Like the bonds would be out of that out of that ETF in another index, in a variety of other ETFs, or not even in an ETF, right? Like they just drop out in the rule. Like if it's passive rules, they fit into what those index rules are. Otherwise, they go off into the land where opportunistic credit funds and insurance accounts and pension funds go buy them because they don't apply to index rules. And that's part of the active management cycle within the ETF space that's creating different opportunities.
All right, well, thank you. And with that, I think we are just about at time. So please join me in thanking our panelists for this great panel today. Thank you all very much.